Okay, so we all know we need a trading strategy in the market to be a profitable trader, but how do we build one and what does it consist of? In this video, I'll be going through my framework to build a trading strategy and essentially giving you a lowdown on what you can use and what I personally use on my trading strategy. So let's get into it. A trading strategy is built of a base, a framework, and a management system. Now, we start with the base. The base is context. Trading strategies have all types of components and they come in all sizes and shapes, but there's one thing that every trading strategy has as a base, and it's reading context of the market. Before you even apply your strategy to the market, you need to have some context, read the sentiment, and get a directional bias. Some ways that may help you read context in the market might be drawing up trend lines, support and resistance lines, focusing on structure and volume. For me personally, a lot of the principles that I use were actually taught by Al Brooks. I did his course on price action a while back now. It's probably one of the cheapest courses that are actually out there on price action, and it teaches you a lens on how to look at the market. He mentions things like measured moves or two-legged moves in the market, and I use this way of reading price action to help me get a directional bias. He also talks a lot about how the candles are actually forming. Are the bodies very large when the price moves up? Is there gaps in the price? Is there a lot of wicks on the bottom of the candles? Then we're most likely bullish. But if the bodies of the down candles are very large, the wicks are all on the top, and there's gaps as we're moving down in price, it's a very bearish market. These are aspects that I've taken in to understand how to read the market context and I guess get a directional bias when it comes to looking at the chart. This is before I have even implemented my strategy, and this is a base and a fundamental aspect of every single trading strategy. If you think you can pick up an indicator or a trading strategy and not take this into consideration before every single trade, you will not be profitable. If you're interested in checking out Al Brooks' course, I've got the link down below. He's also got a book called Bar by Al Brooks, and it is one of the best books I've ever read. It is very long, but it's worth a read. I'll leave that in the link below as well. In conjunction with Al Brooks' methods, I also use Anna Cooling's methods on how to read volume. Things like when a candle is small but the volume is very large, it could possibly mean that there's absorption in that area and price is about to reverse. If volume is spiking on the down candles, price is likely to move up, and vice versa. There's so many good gold nuggets in these books, guys, so click the link below. I will leave that one down there as well for you. Next is a framework which comes in 3 parts: your stop loss, your take profit, and your entry. Number 1 is your stop loss, and the reason why I bring it up first is because before any trade, you need to understand where your stop loss is so your risk is defined. Without a stop loss, you're unable to calculate how much risk you're able to put in on the trade. To calculate that, you need to understand where your stop loss is, so this must come first with any trade you take. Examples of places you could put a stop loss is support and resistance levels, below the EMA, or even below the last candle or your entry candle. For me, I use the low or the high of my entry candle, and this is because I'm entering on the absolute bottom of the pullback, expecting price to continue in my direction. Number 2 is take profit. Now, again, the reason why this is number 2 is before you take any trade, you need to understand what is your expected value out of your trade, and you need to understand that it has to be a profitable trader's equation, which we'll get into in just a second. But you need to understand, without understanding where your possible take profit is, there's no way of you knowing if it's a good trade to take. Your trader's equation must make sense before every trade you take. The trader equation also came from Al Brooks, is your win rate times your average win, take your loss rate times your average loss. If that amount is not positive, your trader equation is not profitable. Now, it seems very confusing and a little bit complex, but to put it in simple terms, you need to be winning more than you're losing. Now, this doesn't mean that your win rate has to be really high. What I mean is, let's say you had a win rate of 30% only, but if you had a win to loss ratio of about 5, so every time you lost 1R, you won 5. If your win to loss ratio, let's say let's actually do the calculations here. So let's go ahead. If you, out of 10 trades, you only won 3 of them. So 30% of those trades you won and 70% you actually lost, but you had a win to loss ratio of 5. So for every 1% you lost, you won 5%, okay? We won 3 trades. So let's do that first. 5 times 3, because we won 5% out of those trades. Okay, that's 15%, all right? Then you take your 1% losses, but you had 7 of those, okay? Because your win to loss ratio, you lose 70% of the time. You take 7, that's 8, but it's a positive number, which means your trader equation is still positive. This is what I mean by you need to win more than you lose. It doesn't mean your win to loss ratio, it means your trader equation. It is so important because before each and every trade, you need to look at it as a probability. You need to be thinking, is it probabilistic that this trade will win in my favor from a trader's equation perspective? Now, examples of take profit levels could be supply and demand levels, resistance or support levels. Some people even do EMAs or measured moves. Now, for me, I personally use measured moves. Again, this is something that I did take from Al Brooks. Now, number 3 is entry. And I just want to kind of segue for a second and just say this is not the most important part about your strategy. I know when I was a fresh trader, I just obsessed over my entries. And although it is a part of the learning process, it is not the most important, and you will come to learn this. But the entry has 3 components: where you're going to be entering, what signals that there may be a possible entry, and what triggers you to actually enter. Where you enter is normally some sort of level. It could be a supply and demand zone, support and resistance, at an EMA, at a trend line. For me personally though, I use 50% levels. Now the reason why I personally chose this is it sat logically with me with how markets work. Imagine if you see your favorite product shoot up double the price, right? And you're like, damn, like I should have bought it a week ago because I love that product. But then it comes back down and there's a big discount and your product and your favorite product is half price. Are you likely to want to get in and jump at that price because you feel like it's a value? Yes. And that's why, to me, the 50% level retracement method it's really sat well with me because it makes sense from a logical standpoint. And this is something that I want to mention is when you're choosing something of your strategy, make sure you understand the logic behind it so you have faith in that strategy. I felt like if I were to just pick random levels like Fibonacci or even trend lines in some circumstances, although I know they do work, I just don't connect with them in the way that I do with 50% moves. And that's why I chose this as a method for me. Now, I also use resistance levels to create an area. Now, I just want to touch more on this as well because your level into which you possibly may enter a trade in, although it may be a line, levels don't work as like a hard solid ground, okay? They work a bit more like a rubber band. They're not going to always instantly work, and price isn't always going to respect that level. It may leak past it and then continue, but that doesn't mean that level isn't valid. And that's why these next few steps in your entries are so important to understand, because you're waiting for something else to trigger you. You're not just jumping in at any random level. So the next component of your entry is the signal. Now, this is something that tells you, hey, get ready, measure up your risk. This could be a setup here. You want to be ready to jump in at this point. Whatever this signal is, this is telling you, hey, calculate your risk, calculate how many contracts you're needing to get in at, and you're getting ready. You're literally putting it in your broker's platform and you're getting ready to press that buy or sell button. Now, this could be many things, and I probably won't be able to fit all of them in this video, but this could be something like an EMA crossover, a candle pattern, or a volume pattern. For me, it's actually peak of volume. Now, the reason why I look at peaks of volume is because this could signal to me that there may be trapped sellers or buyers in the market. This helps me understand that a change could be happening and there's a lot of interest at that level. As I said, I can't go through everything in this video, so if you're interested in knowing more information about any of this, leave a comment below or go ahead and check my channel out and see if I've already discussed it. Third is the trigger. So this is when you actually get into the trade. This could be a break of a high of the previous candle, an EMA crossover again, or for me, it could be a signal on the tape or time and sales. I've actually done a video on this and discussed how I use the time and sales to get my entries. So go ahead, check the channel out and you'll see it there. I chose time and sales because I found that it was most accurate when entering my trades, but something to consider and something very important to actually discuss at this point is depending on what time frame you're trading, some of these things may work better for you. Time and sales isn't really built for long-term traders. It's more for that shorter to intraday trading, whereas those candle patterns really come in handy when you're doing long-term trading. So that is something to consider when you're taking these down is what trader are you? Do you prefer a shorter time frame or do you prefer a longer time frame? And how does that react when it comes to my trading strategy and what you want to choose to use? And the only way you're going to be able to make that work is by really understanding those nuances and making sure you understand the characteristics of your trading strategy. Lastly, and I found that most recently, this is one of the most important pieces to, I guess, the framework of a trading strategy, and it's the management system. There are three main components to the management system, and it is risk management, emotional management, and trade management. Risk management is understanding how much money you're wanting to put on the line. Now, this could be per day, this could be per trade, this could be per month. You need to form something. Now, this is very personal because each person has a different risk level and also reacts differently to certain risks. So this is something to consider because you'll notice within the management system, some things will intertwine depending on your personality. But this is where you understand how much you should be risking on each trade based on your trader's equation, okay? Some people use dynamic risk, so essentially changing your risk per trade based on how confident you are, or I guess the probability of your trade, okay? So whether it's a A+ setup, you're gonna be wanting to risk more on that setup, whereas if it's a C setup, you're probably not wanting to risk as much. So you could approach it in a dynamic way. For me personally, since I've started trading, I've done a fixed risk approach, and that's simply because it's easy to calculate on a much shorter time frame. I know the numbers so I can calculate it very quickly. I don't have to pop out a calculator and work out what that is, right? So that's why I chose a fixed method, is because I'm trading shorter time frames. I need to be quick when it comes to that. And as I scale up my risk, I will also continue to do it in numbers that I can easily and quickly calculate. Something to talk about or note in this part of your strategy would be what days to trade and what days not to. So what signals you to not trade one day? Now, some people, it could be that the R vol is really low one day, which means there's not a lot of relative volume in the market and it's not really going to do much, right? It could be that the price action itself looks very choppy and it doesn't look very good, so you're not going to trade that day. That's managing your risk because it's unlikely that that day is going to give you profits. Something else to consider is your daily risk limit. So essentially, if you've lost a certain amount for the day, you should stop trading. Now, this is very closely linked to the next component, which is emotional management. And it's because, again, this is very personal to you. I personally have 3R or 3 trades as my risk limit. And that's because past that point, I normally know that I'm over trading or not performing well. And I get quite emotional and start emotionally trading after 3 losses. So that's normally my cutoff. Something else that I've implemented with emotional management is basically getting my head in flow state before I start my trading session. If you've been watching my trading recaps, in some days I come up to the chart and I'm very flustered and I just don't perform well, right? I'm not in the right mental state to be trading. And that can be very hard when you work full time and you're doing all these other things, to then sit at a chart and just be narrowed in and focused on what you're doing and get into that flow state. And so what I brought into my management was the fact that I need to basically visualize my trading for 5 minutes. I basically do almost like a meditation where I'm thinking about my trading and I'm visualizing my trades, and I do that for 5 minutes, and then I journal what I most want to focus on that day, because normally I'm trying to do my 1% improvements each day. So I'll be journaling about what I really want to be focusing on and improving on in the trading session. And after that is only when I can then trade, because what it's given me the ability to get my head in a trading space. I'm thinking about trading. I'm visualizing trading. I'm thinking about how I should be reading context or whatever it may be right before that trading session, rather than just jumping right in. We can't not trade with emotion, okay? That's unrealistic, okay? But what we can do is control what we do and make rules to help us guide us through that emotion. So what I brought in is basically, if I've lost a trade, I can have a second go at that trade. If that loses again, it's very likely that there's something wrong with the trade, even though everything looks perfect context wise, okay? Because at the end of the day, trading, you'll never get 100% win rate, right? And sometimes you're just gonna have unlucky trades where the context looks right, you traded to your rules and it still loses. And those are the trades that catch me off guard, because I feel like it should have won and I can be quite confident on them sometimes. And that's what makes me continue to just, I guess, lose my total daily loss limit on this one trade, right? One trade setup. So what I brought in was that I can take 2 tries, and if it still loses, I've got to walk away, go do something else, and come back, okay? What that allows me to do is allows me to reset, look for other setups on the chart, but it doesn't waste my whole daily loss limit on one trading setup. It gives me one more chance to come back. And based on my trading strategy, if I lost 2 trades and risked the correct amount, but won the last trade, I'm likely to still be up or at least break even on that day. All right, so the third thing on a management system is trade management. This is how you plan to manage your trade whilst you're in the trade. Now, it's very important. This is probably one of the most important things. And this is because when you're in the trade is when you're going to be most emotional about your trade, okay? The ups and downs of the movement is when it's going to trigger emotions. You're going to get fearful. You're going to get greedy. So you need to have rules around it to help you judge when to get out of that trade, okay? Even though you've got to take profit, which we will get to in a moment, it helps you understand where to put your stop down, if at all, okay? Some trading strategies, you may simply have a stop loss or a take profit, all right? It helps you manage that trade, okay? And manage your risk whilst you're in the trade, okay? And this is what creates the edge. So for example, if your trade management strategy is to pull your stop at break even, at what point do you pull your stop at break even? Now, me personally, if your trade goes to, let's say 2R, and like that's a rule to bring it to break even, to me that makes no sense, because you're trading off dollar figures. You're not trading off what the chart is actually telling you. And this is why I personally trade off mostly context when it comes to trade management, because I may have my measured move take profit, which is my take profit, but sometimes I'll get into a trade and what will happen is the price action's weak, and then we might have a 2-legged move, again referring to Al Brooks here, but it's quite a weak 2-legged move. Price action's telling me that we're not going to go much further. I might take profit there because price is telling me that it's not going to go much further. It still might be a 2R trade, and based on my probability of my trade, it is a successful and positive trader's equation, but I need to get out there. It's not going to turn out how, I guess, my normal TP was, right? And that's something to consider, and that's why a lot of people do bring in these break-even stops. But I just want to mention that it shouldn't be based on a money figure. It shouldn't be based on arbitrary reasons. It should be based on what the chart is telling you. Has the chart created a higher low that you can then drag your stop to, okay, up to? Whatever it may be, is the chart signaling for you to do this, or are you just doing it because you don't want to give back profits? That's the difference here. And that's why you should have rules to help you get through this. So this could be dragging your stop loss up to or below the EMA, okay? This could be dragging your stop loss up above the high low. It could be all different types of things. For me, I like to use volume nodes, which again, I've got videos on footprint charts if you want to check them out on my channel. I can't go into everything on this video, but for me personally, I'm very heavily driven into context, so how the market's actually moving whilst I'm in the trade, and also volume nodes that appear whilst this is all happening. It's so important to understand that each strategy is so personal and individual to the person and the trading strategy itself. And you must backtest and paper trade these strategies to really understand the nuances and make sure they're profitable, right? Because you could pick all these pieces together and just kind of put it all together and hope that it works, but you need to make sure they're profitable, right? So you need to backtest them and you need to journal your trades and really understand your trading strategy on like a micro nuanced level. Something you need to also understand is what time frame do they work best on? As I said, some of these things that I'm throwing out here just as ideas for you guys, some of these may work on high time frames and some of these may work on lower time frames. So you really need to work out what works for you and make that strategy come together. Something that I always come back to with creating a strategy is create something that is based in logic. Markets can be illogical and emotional, and that's normally comes by like peaks of volume and all of those sorts of things. Normally you can see that in the market, but markets are pretty efficient and they're pretty logical and they're run by people, right? You know, it's not complicated. So there's normally some sort of reason behind it. And that's why for me, I read context just to understand what's the sentiment. You know, what is everyone else doing in the market? Is most people feeling bearish? Because if we're heavily bearish and context says that, then we're likely to be heavily bearish, vice versa. That's why I use context. And that's why I also use 50% levels for my area of where I enter. That's why I use volume peaks, because that's trapped sellers normally, or trapped buyers, okay? And also using the time and sales to enter, again, it's because that's literally what's happening. I can see sellers be absorbed and buyers start stepping in, and I can see the control change there, right? And that's real-time data, and that's why I chose those methods, okay? So I always say, whenever you're choosing something, try and choose it in logic and like understand how you understand it. It needs to feel right, and if it's logical and seems logical for you, you're gonna be able to stick and understand the strategy a lot more. If you wanna check out more about how I trade, I have made a video on Al Brooks. I've also made a video about volume and how I read the time of sales, so go check that out. Again, always journal your trades, guys. So if you do want to check out TradeZella, which is what I use, it makes trading so much easier, and you can actually now get 20% off your first year if you use the code NOVICE10. So click the link below and sign up today. Otherwise, I hope you enjoyed it. I try my best to kind of cram these videos with as much value as I possibly can. So I hope you enjoyed it, and I always love the support and comments and likes, guys. So thank you so much. I'll see you in the next video. Thanks.